All right, then, finance friends, welcome back. Uh, you had asked for some more videos in terms of problems and solutions, ways to kind of work out cases. So in this one, topic 30, you asked for it, I gave it to you. Let's do some problems and solutions, crunch some numbers for bonds. Okay, let's do it this way. I've written up 10 case studies. Let me read them to you. And then you may want to pause the video, stop the video, work them out, and then turn it back on, and then go through solutions with me, okay? So 10 cases. Case number one, Joe purchases 20 bonds with par values of $1,000 each. The bonds carry a coupon rate of 9%, payable semi-annually. How much will Joe receive for his first interest payment? Case number two, Bonnie has paid $9,500 for corporate bonds. Those bonds have a $10,000 par value, a 9% coupon rate, and that's payable annually. Bonnie has received her first interest payment after holding the bonds for 11 months, and then she sells them, pulls in $9,700. If Bonnie is in the 35% tax bracket, what are the tax consequences of her ownership and sale of those bonds? Case number three, old Enzo paid $9,400 for a bond. That bond had a $10,000 par value and a 6.5% coupon rate. 2 years later, after having received the annual interest payments, he sold the bond for $9,700. What are Enzo's total tax consequences if he is in the 25% marginal bracket? Case number four, Mia, who wants to invest in treasury bonds with a $20,000 par value of 4.5% coupon rate. The bonds have a 10-year maturity. Mia requires a 6% return. How much should she be willing to pay for those bonds? And let's assume that interest is paid annually. Case number five, Emma is considering a bond purchase. The bonds that she is looking at have a $10,000, pardon me, a $10,000 par value, an annual coupon rate of 8%. They mature in 6 years. The bonds are currently priced at $9,550. If Emma has determined that she requires a 10% rate of return, should she buy those bonds? Case number six, Mark has a bond, par value $30,000, 6% coupon rate, 15 years to maturity. He needs to sell this bond. New bonds currently carry coupon rates of 8%. How much should Mark sell it for? Case number seven, an extension. Let's say that instead, Mark's bond originally, when he bought it, had a coupon rate of 9%, and new bonds are still offering coupons of 8%. Given this new information, this new variation, now how much could Mark sell his bonds for? Case number eight, you own a muni bond that yields 3%. You are in the 28% tax bracket. What is your taxable equivalent yield for this muni? Case number nine, you see a $1,000 par value bond. It's paying an annual coupon of 5%. It's going to mature in 9 years. It's currently quoted in the financial press at 99. What is this bond's current yield? What is this bond's yield to maturity? And finally, case number 10, you paid $1,000 for a bond that pays a coupon of 4%. At the end of the year, the bond is worth $1,050, and you are in the 25% tax bracket. Given this information, what is your before tax return and what is your after tax return? Let's assume that you did not sell the bond. So my friend, there's 10 cases. These are about valuations, making decisions, the different yield and yield ratios, things like that. Big thing, remember that you have to keep your bond jargon straight. The bond's par value, the bond's coupon rate, those are tied to the bond at issuance. You have to keep those separate from the bond's current value or its market value. And you have to keep that earlier stuff, especially the coupon rate, separate from your required rate of return. Okay. The coupon rate is what the bond pays by way of interest. The required rate of return is what you need in a new investment. That can be seen as the opportunity cost, for example, usually tied to market interest rates for assets of comparable risk. Critical thing, remember, the value of a bond is the discounted value of all future cash flows. The discount factor that you're going to use is the required rate of return, not the coupon rate. Okay. So with that said, feel free to pause me, try to work these things out. And then when you're ready, come back and match up your solutions to mine. Okay. Good luck, friends. See you in a bit. As the game show hosts say, and we're back. All right, friends, hopefully you've worked these out. Let's go through them together and try to get some solutions, okay? Case number one, Joe purchased 20 bonds with par values of $1,000 each. The bonds carry a coupon rate of 9%, payable semi-annual. How much will Joe receive for his first interest payment? Well, your interest is simply your par value times your coupon rate. Since this is being paid semi-annually, divide that by 2. So you should have gotten $20,000 times 0.09 divided by 2 equals $1,800 divided by 2, $900, his first payment. Case number 2. Bonnie paid $9,500 for corporate bonds. So this is what she paid for it. They have a $10,000 par value, a 9% coupon rate, and to keep it simple, they're being paid annually. Bonnie received her first interest payment after holding the bond for 11 months, and then she sells them for $9,700. Okay, that 11 months is a clue. There's going to be a short-term gain and therefore taxed fully at her bracket, which is 35%. What are her tax consequences? Well, remember, my friends, bonds generate value in 2 ways. The interest flows, the current income, and the potential capital gain. We have both of those. Her total tax consequences, let's break into 2 parts. Number 1, her current income, $10,000 par value times 9% coupon equals 10,000 times 0.09 equals 900. Second part, her capital gain. She sold this for 9,700. She paid 9,500, generating a capital gain of 200. This brought her in a total of $1,100 of proceeds. She is in the 35% tax bracket, and therefore her tax consequences would be $385. Critical to remember, 11-month holding period, short-term gain, taxable at your full marginal tax rate. Had she held this for a year and a day or longer, now she's going to get a long-term capital gain with favorable rates on that, okay? The other thing to remember, you need the par value and the coupon to determine the flow of income that came in. You need the actual purchase price and the actual sales price for any capital gain. All right. Case number 3. Enzo pays $9,400 for a $10,000 par value, 6.5% coupon bond. 2 years later, after having received his other interest payments, he sells the bond for $9,700. What are his total tax consequences? Well, we've got a couple of things here. We have ordinary income. This ordinary income would be equal to the current income that he received, right? His interest income, that's ordinary income. This is going to be equal to the $10,000 par value times the 6.5% coupon. And again, we're looking at the total tax consequence. So that's over 2 years. $10,000 par value times 6.5% coupon times 2. This is going to equal $1,300. And then he's going to have a long-term capital gain. This is going to be equal to $9,700 minus $9,400. What he sold it at, what he bought it for. This is the capital gain of $300. Now here's the key. This $1,300 here, this is going to be taxed at ordinary income times 0.25. And this is going to give you $325. On the other hand, his long-term capital gain, long-term, good tax treatment, is only going to be taxed at 15%. So this is going to be $45. So he's going to be facing $325 of regular tax on the ordinary income from his interest, $45 of favored tax based on the long-term capital gain. You add 325 and 45, Enzo's full tax consequence, $370. Good. Case number 4. Mia wants to invest in treasury bonds. They have a $20,000 par value, 4.5% coupon, 10-year maturity, 6% required rate of return. Critical that you understand the 4.5% coupon rate. All that is telling you is the interest that that bond pays. And that coupon rate was set upon the issuance of the bond. On the other hand, Mia's 6% required rate of return reflects her discount rate. You can see this as the opportunity cost that she needs to bring in, probably because market interest rates for comparable assets of comparable risk are probably paying 6%. Okay, so we have to make sure we differentiate between what the coupon rate is and what the required rate of return is. Got to keep them separate. They tell you different parts of the story. Okay. With that said, the question is, how much should Mia pay for the bond? And again, to keep things simple, we'll say this bond is paid annually. Well, you guys know that a bond's value is ultimately the present value of all the future discounted cash flows. And to do that, we need 2 different tools. We need the PVIFA. This is going to give us the present value of an annuity, the annuity in this case being the sequenced regular payments over time, the interest. And we're going to need the PVIF, the present value interest factor. This is for the lump sum for the $20,000, which is going to come due in 10 years. Okay, so now we know we need 2 pieces. What are our factors? Well, we know that we have a 6% required rate of return and a 10-year maturity. So we're going to be looking at the PVIFA of 6% 10. This is going to be 7.360. This is the factor by which we will discount all those future cash flows of interest, those coupon payments. We also have to determine the PVIF for 6% 10. This is going to be the discount factor for the lump sum, the principal repayment in 10 years. PVIF, excuse me, 6% 10 is equal to 0.558. And therefore, to solve this, the value of the bond will be equal to $900 times 7.360. Why $900? Because $900 is the coupon that you earn, the interest that you earn when you have a 4.5% rate and a $20,000 par value. If Mia buys this bond, she's going to generate $900 of interest a year. We have to take the discounted value of those. $900 times 7.360, and we're going to add that to the discounted value of the lump sum repayment, which will be $20,000, which is the bond's par value, multiplied by 0.558. And when you do this, you would get 6624 plus 11160. And therefore, we would value this bond at $17,784. This is the max that Mia should pay for this bond, because this represents the present value of all future cash flows discounted by her 6% required return rate over the 10 years that she'll hold the bond. Okay, there you go. Number 5, Emma. She wants to consider, she's considering buying some bonds. The bonds have a $10,000 par value. They have an annual coupon of 8%. They mature in 6 years. And critically, they are priced at $95.50. Emma requires a 10% required rate of return. It's her discount rate. So here's the question. Should Emma buy those bonds? This is a unique question. It's not hard, but it's unique in that there's actually 2 ways to approach this, which will both yield, get it? Pun, the same answer. Let's first do it. Well, let's first recap our information. Let's put it all nice and organized so we can make a good analysis. So our par value, $10,000. Our coupon is equal to 8%, which will basically be an $800 interest payment annually. Our maturity is 6 years, and the current value of the bonds, they're selling at $9,550. How can we solve this? Well, let's first solve it through a straight valuation method. If we do the formula, we value this bond as the present value of all future discounted cash flows, we would get this. The value of the bond will be equal to PVIFA 10% 6 times 800 plus PVIF 10% 6 times 10,000. Remember, 10%, we're using that rate as our discount rate because this is what Emma requires. 6, that's our time frame because that's our window to maturity, which is how long these flows need to be discounted by. 800 is the coupon, which is an annual payment of interest, therefore an annuity factor. $10,000 is the bond's par value, which is what will be paid back at maturity. You put all this together, my friends, and you will get equal to 4.355 times 800 plus 0.564 times 10,000. 3484 plus 5640. So Emma should value this bond at 9124. Since she would value the bond at 9124, but the bond is priced at 9550, should she buy the bond? No, because you never buy an asset if its expected valuation is less than what you're paying for it, right? That's common sense. You would never spend $95.50 for something worth $91.24. So one way to answer this is through a straight up valuation. But there's another way we can answer this. Let's go through that. The other way to answer this is by calculating yield to maturity. So our second methodology is yield to maturity. Remember, yield to maturity reflects an asset's return to you, your return, your yield, assuming that you hold it to maturity. Yield to maturity gives you a very nice way to get a sense of what this asset will generate if you hold it until it matures. We have a simple formula to approximate yield to maturity, and that was the interest factor plus divided by n, which is the number of years to maturity, all of that divided by, well, we plug these numbers in, we would get 800, which is our coupon, our interest that we're going to get paid, plus 10,000 minus 9,550 divided by 6, because n is our number of years to maturity. We divide all of that by 10,000 plus 9,550 divided by 2. We crunch this out. This will be 800 plus 75 divided by 9,775 equals 875 by 9,775. So basically, my friends, what we've calculated here is if, in fact, Emma buys this bond with these characteristics, this will effectively give her an 8.95 return, 8.95% return. The yield to maturity, the amount that she is expected to pull in from this bond, 8.95%. So you're saying, okay, Young, we get it, but so what? Who gives a shit? What's the big deal? Here's the big deal. This number, 8.95%, is what she's actually going to get. This number, 10%, is what she needs to get. Since her actual return falls short of her required return, once again, no to this bond. Okay. So whenever you're making a decision, an opportunity cost decision about should I buy this or should I not, know that there's different ways to approach it. None is better than the other. Use the one that works for you. Okay. You have a valuation method and a yield to maturity method. Because it's the same data and it's the same type of analysis, we yield the same conclusion. Okay. Excellent. Case study number 6. Old Mark. Bond has a par value of $30,000, 6% coupon, 15 years to maturity. He needs to sell this bond. New bonds currently carry coupon rates of 8%. Notice that there's a discrepancy between the coupon that Mark's bond pays and the coupon that investors could get from new bonds. Since the new bonds have a coupon of 8%, that's going to make Mark's bond less valuable. We can predict that this bond would probably have to trade at a discount. Let's figure it out. Okay, let's knock out a little summary of our information. PV, the par value, $30,000. The coupon is going to be 6%, which will generate $1,800 of interest every year. We have 15 years to maturity, and we have a required rate of return equal to 8%. Valuation is simple. present value of all future cash flows discounted by the required rate of return. So we are going to do this. The value would equal PVIFA 8% 15 times 1800 plus PVIF 8% 15 times 30,000. You go to your tables as you know how to do. This will be 8.559 times 1800 plus 0.315 times 30,000. Add it all up. 15,406.20 plus 9,450. He can sell this bond for $24,856.20. There you go. And notice again, we predicted it would have to sell at a discount, and it is. He can only sell for $24,856 a bond with a par value of $30,000. Okay. So all these different ideas come together. We make sense. We bring all these separate strands of knowledge in to make sense with the example. Let's modify this example. Instead, let's assume that Mark's bond, up here we said it had a coupon of 6%. Let's say that actually it had a coupon of 9%. New bonds still offer 8%. Let's recalculate it. Now, in this one, we see something interesting because Mark's bond has a coupon that is in excess of new bonds. We would predict that this bond would trade at a premium. Let's see if we're right. If the coupon were 9%, then the annual interest payments would be $2,700. We pop some numbers in. PVIFA 8% 15. You're saying, but why 8%? Why not 9%? Because remember, we're discounting it by the required rate of return, which is basically the opportunity cost or the current market rate. The 9% interest rate is simply the coupon payment. That is not the discount factor, okay? It's very confusing. So let's make sense of those numbers. Back to our analysis, PVIFA 8% 15 times 2,700 plus PVIF 8% 15 times 30,000. This will equal 8.559 times 2,700 plus 0.315 times 30,000 equals 23109.30 plus 9450 equals $32,559.30. As predicted in this modified case study, indeed, he can get $32,559 for an asset that had a par value of 30. He can sell it at a premium, and that premium reflects the change in interest rates since he bought it, okay? Excellent, excellent, excellent. Let's go to our next one. Case study number 8. Pretty straightforward thing here. You own a muni bond. That bond is going to yield 3%. You're in the 28% tax bracket. What is your taxable equivalent yield? Taxable equivalent yield, remember, is a calculation that you have to do to equate apples to apples. In other words, you know that muni bonds are tax exempt. Therefore, what you would do is this. The taxable equivalent yield is going to be equal to 0.03, which is your yield, divided by 1 minus your tax rate. Equals 0.03 divided by 0.72 equals 0.0417 equals 4.17%. What does this mean? Well, it means this. If in fact you are in the 28% tax bracket and you have a muni that yields you 3%, this is the equivalent of getting 4.17% on a bond that is taxed. And therefore, if you were ever making a comparison between, for example, this muni bond and a corporate bond, which is taxed, you would need to pull at least 4.17% from a taxable corporate bond in order to make it equivalent to 3% on a tax-free muni. Again, a large part of personal finance is opportunity cost decisions, making the correct apple-to-apple comparison. The taxable equivalent yield formula is a tool to do that. Number 9, case study 9, UCA bond, $1,000 par value, annual coupon 5%, maturing in 9 years, and it is currently quoted in the financial press at 99. Question 1, what is the bond's current yield? Well, you know that the current yield is equal to the coupon divided by the current market price of the bond. Oops, current market price. Well, what's the coupon? Well, the coupon is equal to the par value times the coupon rate. So 1,000 times 5% equals 50. Market price, well, what's the market price? Well, you can get that as well. If this bond is quoted at $99, at the factor at 99, you know how bond quotes work, they're percentages. So a bond that's quoted at 99 means that it's selling for 99% of par. 99% of 1,000, it's selling for 990. And now it's a simple matter of dividing, and you would get 5.05%. That is your current yield. What is your yield to maturity? Remember, current yield is like a snapshot. It tells you how much this thing pays as a function of your interest payment. Yield to maturity factors in the return that you get, including your gain at the end if you hold it to maturity. We have a simple formula which we learned. The yield to maturity is equal to I plus FV minus CV divided by N divided by FV plus CV divided by 2. This would be equal to 50 plus 1,000 minus 990 divided by 9 over 1,000 plus 990 divided by 2, which would equal 50 plus 10 divided by 9 over 1990 divided by 2, 50 plus 1.11 over 995 equals 51.11 over 995 equals 0.05136. Therefore, your yield to maturity, 5.14%. This means that if you were to buy this bond, hold it to maturity, you would pull a total return, a total yield of 5.14%. If you were looking to compare this potential investment, this potential asset to other assets, when you made your apples to apples comparison of which one should I buy, you're going to use the yield to maturity number, because this is basically your real total return if you hold the asset. Okay. One more thing to notice. Notice that the coupon is 5%, yet both your current yield and your YTM are higher. This means that you're going to pull in more than the current yield. This is because the bond is trading at a discount under par. Anytime, mathematically, anytime a bond is trading at discount, you're able to buy it for less than its par value. Both your current yield and your YTM will be greater than the coupon. And the reverse is also true. Finally, case study number 10. Let's knock this one out. You paid $1,000 for a bond. This bond pays a coupon of 4%. At the end of the year, it's worth $10.50, and you're in the 25% tax bracket. Let's think about tax consequences here. $1,000 bond, coupon 4%. End of the year, it's worth $10.50, 25% tax bracket. First question, what is your before tax return? Before tax return is a paper return. Okay, it just factors in the appreciation and the value of the asset plus the current income. This is going to be equal to $10.50, what it's worth, minus $1,000, what you paid, plus 40, which is your coupon, right? $1,000 par value times 4% equals $40 of current income, interest income. You take all this and you divide it by the amount that you paid, 1,000, and you should get a before tax return of 9%. Sorry, pardon me. Yeah, a before tax return of 9%. Final question, what is your after tax return, assuming that you did not sell the bond? Well, to do this one, we do a little modification. You didn't sell the bond, but you did collect interest. You're going to have to pay tax on that interest, specifically 25% tax bracket. So we have to do a slight adjustment to get your after-tax return. It's going to be this. It'll be equal to $10.50, what the bond is worth, paper gain, of course, minus $1,000, what you paid for it, plus 40 times 1 minus 0.25 divided by 1,000. Notice that we have our two parts. This part right here represents your gain on the capital appreciation. This part right here represents your current income, your interest. But notice that we're taking the amount that you made and subtracting the tax that you have to pay. You do all this and you're going to get 50 plus 40 times 0.75. Again, if you think about it, 40 times 0.75 is the $40 interest that you earned multiplied by 0.75, which is the amount of your money that you can keep because your Uncle Sam is taking 25% away. Thank you very much. Okay. You do all of this divided by the $1,000 that you paid for it. This would equal 80 divided by 1,000 equals 8%. Just another way to look at these decisions in a more thorough, prudent way, looking at your before tax and after tax returns, okay? With that, my friends, that's our case studies on bonds. Hope you enjoyed it. If you have any questions, let's talk in class. Thanks, and I'll see you soon.